The $1,200 data tracker. The promise. The pitch is irresistible. Plug in this little device. Let us watch how you drive, and we'll reward your safety with lower rates. It feels modern, fair, a personalized premium. For 90 days, I became their perfect subject. I drove consciously, followed every rule I knew. I awaited my reward. My reward was a $1,200 annual increase. Not because of tickets, not because of accidents, because their algorithm saw patterns in my data I didn't know existed. This is not a discount program. It is the most intimate audit of your life ever sold as a benefit. Your car is no longer just a vehicle. It is a witness. And everything it sees is evidence against you. I let my car spy on me for 90 days. IT cost me $1,200. The Panopticon on wheels. The device, often called a telematics dongle or a snapshot, connects to your car's onboard computer. It doesn't just track if you speed. It constructs a four-dimensional map of your behavior. It knows the how, the when, and the where of every journey. This data is fed into a proprietary algorithm, a black box that assigns you a score. The foundational lie of these programs is the word safe. They are not measuring safety in the absolute sense. They are measuring actuarial conformity. They are looking for the statistical profile of someone who is unlikely to file a claim. And as I learned, those are not the same thing. My experiment began with full transparency. I would follow the common wisdom, avoid hard brakes, watch my speed. But I decided to log every trip against the app's feedback. I became a student of my own surveillance. The 90-day log, what the machine saw week 1 to 3, the obvious penalties. The app immediately flagged hard braking. I learned the threshold was absurdly sensitive, a deceleration of 0.3 gigaseconds, which feels like a normal, assertive stop at a yellow light. Each event was a red mark. Rapid acceleration was similar, merging onto a highway with purpose could trigger it. These were the advertised metrics. I adjusted, becoming a hyper-passive driver, often irritating drivers behind me. Week 4 to 8, the hidden geography penalty. My score began to drop inexplicably. I wasn't braking hard or accelerating fast. The culprit was time of day and route consistency. The algorithm heavily penalized driving between 10 p.m. and 4 a.m., labeling it high risk. My occasional late return from a friend's house or an airport run counted against me more than a hard brake. Worse was the route infidelity. My commute was short, but I sometimes took different streets to avoid traffic or run an errand. The algorithm preferred the identical route every day. Deviation suggested unpredictability, and unpredictability is a risk factor. Week 9 to 12, the mileage miscalculation. The final blow was annualized mileage. The device extrapolates your 90-day mileage to a yearly figure. At the end of 90 days, my report read moderate braking events, occasional late-night driving, route variability, high projected mileage, the safety score, 76, the financial verdict, $1,200. The secret scorecard, beyond speeding. For my experiment and industry white papers, I reconstructed the hidden hierarchy of penalties. 1. The geography and time tax highest weight. Driving in high-risk zip codes, even passing through statistically higher claim areas. Night driving. Any driving after 10 p.m. is severely penalized, regardless of conditions. Unusual destinations. Frequent trips to areas coded for entertainment bars, stadiums versus safe zones, grocery stores, schools. 2. The behavior surcharge. Smoothness over safety. The algorithm prefers gradual, predictable maneuvers over defensive, assertive ones. A hard brake to avoid a hazard is penalized equally with an aggressive tailgating stop. cornering G-force. Taking a freeway on-ramp with normal speed triggers a hard cornering event. Phone connectivity. If you pair your phone via Bluetooth, the device can infer distracted driving from long call durations, even if hands-free. 3. The lifestyle penalty. Low mileage bias. The biggest discounts are reserved for those who drive less than 7,500 miles a year. The system is designed for the urban telecommuter, not the suburban parent. The Goldilocks window, driving between 9 a.m. and 4 p.m. on weekdays is optimal. Early mornings for work, penalized. Evenings for family, penalized. Idle time, excessive engine idling, school pickup lines, drive thrusts can be flagged as wasteful and risky. The result is a profile of the ideal low-cost driver. A homebody who works from home, drives only during the day to predictable, safe locations and operates their vehicle with the gentle caution of someone transporting a raw egg on a spoon. Any deviation from this sterile norm is quantified as risk. The permanent record and the bigger game. The most critical question is, what happens to your data after the program? In the fine print, most companies state they may retain and use the data for underwriting purposes and to improve products. This data profile your driving DNA can follow you. It can be shared with affiliates. It can be sold to data brokers who build consumer behavior models. Future insurers, when you shop for quotes, may one day be able to purchase this historical telematics data to assess your risk, regardless of your current participation. You are building your own inescapable driving reputation. The $1,200 increase wasn't just for my next policy term. It was the first installment on a lifetime of being categorized as nonconformist. The ultimate goal for the industry is clear. Move from insuring the vehicle to insuring the driver's behavior in real time. Pay per mile UBI is the gateway. The next step is real-time premium adjustment. Drive after midnight. Your premium for that trip is 50% higher. Take a route through a high-risk area. Surcharge applied instantly. The OPT out protocol. If you are considering or are enrolled in such a program, here is your protocol. 1. Read the data use policy. Specifically, look for clauses on data retention, sharing with third parties, and use in future underwriting. If it's vague, assume the worst. 2. Know your state's laws. Some states prohibit insurers from using telematics data to increase your premium, only to offer discounts. Others have no restrictions. This is crucial. 3. The withdrawal strategy. If you want to quit a program midterm, call and say, "I am withdrawing from the telematics program effective immediately. Please confirm in writing that my premium will revert to the standard rate and that no further data will be collected or stored." Get this confirmation. 4. The alternative, the low mileage policy. If you are a genuinely low-mileage driver, seek out a formal pay-per-mile insurance policy from companies like Metro Mile or Mile Auto. These charge a small base rate plus a per-mile fee. They are transparent and often cheaper than traditional insurance for sub-10,000-mile drivers without the behavioral spying. 5. The hard no. Your most powerful tool is refusal. The initial discount is a lure for data acquisition. For most, the long-term risk of a permanent, negative data profile outweighs a temporary 5 to 10% discount. A discount that watches you is not a discount, it's a down payment.